If you see a company with massive, like seemingly insurmountable short-term liabilities and practically zero cash in the bank to cover them, your first instinct is probably to assume they're headed straight for bankruptcy.
Oh, absolutely. I mean, you would think the end is near.
Right. But what if that exact financial scenario, owing vastly more than you actually have on hand, is actually the ultimate sign of, absolute ruthless market dominance?
It sounds completely counterintuitive, I know, but in the world of financial analysis, optical illusions are just everywhere.
Yeah, because we're conditioned to think debt is always bad and cash is always good.
Right, exactly. But when you learn to kind of peel back the layers of a company's financial statements, you realize that the numbers don't just tally up the score, they actually reveal the underlying power dynamics of the entire industry.
So today we're taking a deep dive into the mechanics of financial analysis, specifically the frameworks used to tear apart a company's annual report. This is all based on Chapter 8 of the Research Analyst framework.
Right, and we are going to move past just, looking at stock tickers flashing red and green on a screen.
The mission here is to understand how to read a balance sheet, a profit and loss statement, and the cash flows like a seasoned detective. We want to equip you to see the business for what it actually is, not just what the management team wants you to see.
And that detective work, it really starts with just knowing where to look.
Mm-hmm.
To get the full picture of a publicly traded company, you are basically pulling 5 essential documents.
Okay, let's unpack this cool kit. What are we looking for?
So first, you need the balance sheet, which freezes the company and time to show its financial position.
Like a snapshot.
Exactly, a snapshot. Then you need the profit and loss statement, which acts more like a motion picture of performance over a specific period.
Got it.
Then you have the statement of changes in equity, the cash flow statement, and finally, the notes to accounts.
Which we will definitely dig into later because, honestly, that's where the real secrets are buried.
Oh, without a doubt. But when you pull those documents, you almost immediately hit a fork in the road.
Right, because companies typically publish 2 different versions of their financials, don't they?
Yeah, they do. You get the standalone numbers and the consolidated numbers.
And the consolidated version rolls the parent company and all of its subsidiaries, basically any entity where it holds like more than 50% of the voting rights, into one giant combined empire.
That's right. It's the big picture.
But, okay, let me push back on this a little. If the consolidated statement gives me the entire family's picture, my instinct is to just ignore the standalone numbers entirely. I mean, why look at a piece of the puzzle when you have the whole box top?
Well, equity analysts do generally prefer that consolidated view because it shows the total earning power of the empire.
Right, makes sense.
But ignoring the standalone financials is actually incredibly dangerous, especially during a crisis. Let's play out a hypothetical scenario here.
Right, lay it on me.
Imagine a parent company based in the U.S., right? And it has a wildly successful manufacturing subsidiary in a foreign country. On the consolidated balance sheet, the total cash position looks fantastic.
So the empire is flush with billions in liquidity.
Exactly. But is that cash actually sitting in a U.S. bank account?
I'm guessing no.
Not at all. And what happens if that foreign country suddenly faces an economic crisis and imposes strict capital controls?
Oh, wow. So the government rules that no funds can leave the country.
Precisely. Or perhaps the subsidiary took on local debt, and the lenders put a strict covenant in the contract stating that the subsidiary cannot send a single dollar of dividends back up to the parent company until that loan is paid off.
So the cash is effectively trapped in a vault that the parent company can't even open.
Which means if the parent company runs into a severe domestic problem, say a massive lawsuit or just a sudden drop in local sales, and needs cash immediately to survive, that consolidated wealth is completely useless.
So looking at the standalone financials tells you if the parent company actually has the independent strength to survive a localized shock.
You hit the nail on the head. It proves whether the core entity can survive the winter.
And survival really brings us to the first major document we mentioned, the balance sheet.
Right. At its foundation, it's just a simple equation. Equity, which is the owner's skin in the game, plus liabilities, which is what the company owes, equals assets, which is what the company owns.
But beyond just being, a list of property and debts, the balance sheet exposes how a company manages its day-to-day survival through its working capital.
Working capital is the lifeblood of operations. I mean, traditionally, people define it as current assets minus current liabilities.
Right, the textbook definition.
But a sharper analytical framework strips that down to what we call core working capital. You remove the cash, and you remove any non-operating liabilities like short-term bank loans.
So you want to isolate just the pure operational engine, like inventory, accounts receivable, and accounts payable.
Exactly. Basically, how efficiently the company is moving its goods off the shelf, collecting money from customers, and paying its suppliers.
And this brings me back to the paradox we opened the show with.
Yeah.
Take a telecom giant like Bharti Airtel as an example from the source material.
Oh, that's a perfect example.
Right, because in one of their past financial years, they had a current ratio of 0.35. They were sitting on roughly $329 billion in current assets, but they had a staggering $930 billion in current liabilities.
It looks terrifying on paper.
Yeah, optically, having negative working capital like that looks like a massive red flag. You'd think they are going bankrupt, but this is actually a massive flex of industry power, right?
It really is. It is a phenomenal demonstration of market leverage. Think about the daily mechanics of a telecom company.
Right.
When a customer uses their phone, they often pay upfront or have an automatic deduction set up. The telecom company collects cash from millions of users almost instantaneously.
So they have incredible power over the consumer.
Right. But on the other side of the equation, they are buying cell towers, server space, and massive infrastructure from suppliers. And because they are such a massive buyer, they don't pay in cash.
Right, they negotiate incredibly aggressive terms. They might tell a supplier, hey, we'll buy $1 billion worth of equipment from you, but we aren't paying the invoice for 90 or even 120 days.
And the suppliers are so desperate for that massive contract that they just agree to the terms.
So the telecom giant is collecting customer cash on day one, putting that cash in the bank to earn interest, and then not paying their own bills for 3 months.
The suppliers are essentially providing the telecom company with a massive interest-free loan to run their daily operations.
That is wild.
So when you see negative working capital in a dominant, asset-heavy business, it isn't a distress signal at all. It shows they are using other people's money to fund their empire.
Wow. But hoarding cash from suppliers only proves you have bargaining power, right? It doesn't actually prove you're selling a profitable product.
That's a very good distinction.
Because you could squeeze your suppliers all day and still run a fundamentally broken business model. To figure out if the underlying business actually makes money, we have to move from the static snapshot of the balance sheet to the motion picture of the profit and loss statement.
Right, the P&L. It's best understood as an active, downward-flowing waterfall. Think of top-line revenue as a massive river at the very top of a mountain.
Okay, I like this analogy.
As that water flows down, different stakeholders divert streams away. The cost of raw materials takes a huge chunk. Then employee salaries siphon off another stream.
And you're constantly measuring what is left over as you move further down the mountain.
Exactly. And halfway down that mountain, you hit a checkpoint called EBITDA, earnings before interest, tax, depreciation, and amortization.
Yeah, financial analysts seem to treat EBITDA as the holy grail of profitability metrics. But I've always wondered, why do we stop there?
It's a common question.
Why focus on a number that completely ignores the reality of taxes and the cost of debt? Shouldn't we care about the final pool of water at the very bottom?
Well, we do care about the final net profit, absolutely. But EBITDA serves a very specific diagnostic purpose. It strips away the noise of capital structure and the noise of accounting choices.
Unpack that a bit. Let's look at capital structure first.
Sure. So two companies might be identical in how they make and sell widgets. But Company A funded itself entirely with owner equity, while Company B took out massive bank loans and has huge interest payments.
Got it. So if we look at the final net profit, Company B looks less successful simply because of how they chose to finance the business, not because their widgets are less profitable.
Exactly the issue. And then you have the noise of accounting choices, specifically depreciation.
Right.
Depreciation is how accountants spread the cost of a massive asset like a factory over its useful life. It's a non-cash expense.
Oh, so by stopping the waterfall at EBITDA, before interest and before depreciation, you isolate the pure operating efficiency of the business.
You've got it. You can compare Company A and Company B side by side to see who actually builds and sells widgets better, regardless of their bankers or their accountants.
Okay, that makes sense. But even if that EBITDA number is huge, and even if the final net profit at the bottom of the waterfall is massive, we still have a major blind spot, don't we?
We do.
Let's say a company shows $100 million in net profit. My instinct is to assume they have $100 million sitting in a checking account ready to be spent.
Which is the single biggest trap in financial analysis.
Right. If we don't look at the cash flow statement, we might be falling right into it.
Yes, the accrual accounting trap. Under accrual accounting, a business records revenue when a sale is earned, not when the cash actually changes hands.
Let me visualize this for you. I run a software company. I sign a massive 10-year enterprise contract with a client today for $10 million.
Okay.
Under accrual rules, I can recognize a significant portion of that revenue on my P&L this quarter, booking a massive profit, even if the client's contract stipulates they don't have to wire me the first payment until next year.
Exactly. You have manufactured a beautiful, profitable P&L, but your bank account hasn't grown by a single cent.
I just have paper profits.
Which is why the cash flow statement is the ultimate reality check. It strips away all the accrual accounting rules and only tracks actual dollars moving in and out of the bank.
And it separates cash into 3 buckets, right? Operating, investing, and financing activities.
Correct. So if you're looking at a company that has shown growing net profits on its P&L for 3 straight years, but its cash flow from operating activities is consistently negative over that same period,
You're basically looking at a ghost.
you are looking at a company bleeding out. You cannot pay your employees' salaries with paper profits. You cannot service your debt with paper profits.
Right.
If a business consistently generates negative operating cash, it has to survive by either draining its historical cash reserves, constantly borrowing more money from banks, or continuously diluting its shareholders by issuing new stock.
And eventually that music stops.
It always does.
So paper profits can be complete illusions. And where do we go to catch the illusionists? We dive into the fine print, the notes to accounts.
The notes are everything.
Because the main financial statements give you the final numbers, but the notes explain the specific, highly subjective methodologies management use to arrive at those numbers.
Exactly. One of the most critical sections in the notes is significant accounting policies. We touched on depreciation earlier.
Right.
A company might use straight-line depreciation, taking an equal slice of an asset's value as an expense every year. Or they might use a written-down value method, which front-loads the expense, taking bigger chunks out of profit in the early years.
But both methods are perfectly legal.
They are. But the red flag goes up when a company frequently changes its method. Imagine a company having a terrible sales year. They're about to miss Wall Street's profit targets.
Uh-oh.
Suddenly, they announce a shift from accelerated depreciation to straight line. Overnight, their stated expenses drop, and their net profit magically spikes.
Wow. They didn't sell a single extra product. They just changed the math to manufacture earnings.
Exactly. The notes are also where you uncover the off-balance sheet landmines.
Right. Things that aren't technically classified as current liabilities, but could, destroy the company tomorrow.
A classic example is a massive pending lawsuit or complex derivative contracts.
Yeah, if you just read the pristine balance sheet, you completely miss the legal anvil hanging over the company's head.
This underscores exactly why the auditor's report is the first thing a seasoned analyst reads. Management writes the financial statements, but the independent auditor has to verify them. You are always searching for an unqualified report.
Which is funny because in plain English, calling someone unqualified is an insult.
It really is.
But in accounting, an unqualified report is the gold standard. It means clean. No qualifications, no caveats.
Right. An unqualified opinion means the auditor believes the statements present a true and fair view of the company's reality. But if the auditor issues a qualified report or the nuclear option, a disclaimer of opinion, they are essentially waving a giant flare.
Like a huge warning sign.
Yes. They are stating on the record that they disagree with how management applied an accounting policy, or that management hid vital information from them.
It's the ultimate warning to just walk away. But let's assume the auditor signs off cleanly. We trust the raw numbers. Raw numbers still need context, though.
Always.
I mean, earning $1 million sounds fantastic until you realize it required $2 billion of capital to generate it. So once we trust the data, we have to make the numbers talk to each other, and that requires ratio analysis.
Ratios transform raw data into diagnostic tools. They help us understand proportions and figure out exactly what is going right or wrong inside the operational engine. They have 3 uses: descriptive, diagnostic, and predictive.
A perfect diagnostic example involves Party Airtel again. In one specific year, their total revenue dropped by a microscopic 2%. It was basically flat. But their EBITDA, that core operating profit we established as the Holy Grail, cratered by nearly 14%. If you just look at the raw millions and billions, the disconnect is baffling. How does a tiny scratch on the top line create a massive bleeding wound on the bottom line?
It seems impossible.
But the moment you apply ratio analysis, expressing every single operating expense as a percentage of total revenue, the culprit practically jumps off the page.
Yes, the ratios revealed that their network operating expenses had suddenly spiked as a percentage of their sales.
The illness was instantly diagnosed.
Exactly. Diagnostic ratios find the leaks in the ship. But the ratios that dictate investment decisions are the return ratios, specifically return on equity, or ROE, and return on capital employed.
Let's focus on ROE.
Sure, it measures how much pure profit a company generates for every single dollar the shareholders have invested. It is the ultimate measure of management's ability to compound wealth.
But wait, how could ROE be deceptive? If I see a company generating a 90% return on equity, my instinct is to buy that stock immediately. How could a 90% return ever be a bad thing?
To understand the trap, we have to tear that single ROE number apart using a framework called the DuPont analysis.
Okay, wait out.
DuPont breaks ROE down into three distinct multiplying factors. First, the net profit margin, how much of every dollar in sales actually becomes profit.
Makes sense.
Second, the asset turnover, how efficiently the company uses its factories and equipment to generate those sales. And third, the equity multiplier, which is simply a measure of financial leverage or debt.
So margin, turnover, and debt.
Yes. So imagine two identical hypothetical companies from the source text, High Lev Co. and Low Lev Co. On the surface, High Lev Co. boasts that incredible 92% ROE. Low Lev Co. only shows a 52% ROE.
Right, so the novice investor just buys high level.
Exactly. But when we apply the DuPont analysis, the story flips completely. We look at the first two factors and discover that Low Lev Co. actually has vastly superior profit margins and much higher asset turnover.
So Low Lev Co. is better at pricing its products, better at controlling its costs, and better at utilizing its equipment.
They are.
It is objectively a superior, more efficient business. How does the inferior company have an ROE that is almost double?
Because of that third factor, leverage. High Lev Co. has taken on a colossal amount of bank debt. They are using massive amounts of borrowed money to artificially inflate the returns on the very small sliver of actual equity they have in the business.
Oh, wow. So that 92% return isn't a sign of operational brilliance. It's a sign of extreme financial risk. It's a house of cards.
Precisely. If interest rates tick up even slightly, or if they have one bad sales quarter, the debt payments will wipe them out. DuPont analysis saves you from buying into a debt-fueled illusion.
It forces you to look backward to see exactly how a company generated its historical returns. But investing is ultimately an exercise in looking forward, right?
It is.
And forecasting the future is where even the most brilliant financial analysts stumble.
Because it is incredibly tempting to just look at a spreadsheet showing 5 years of steady 10% growth and draw a straight line into the future.
Yeah, but the business environment isn't a vacuum. Competitors emerge, technologies shift, regulations change.
Right. Warren Buffett often warns that complex financial projections create an illusion of apparent precision. We build these incredibly intricate models that give us a false sense of security.
Or, as Charlie Munger put it, a past trend is a fact, but a future trend is just an assumption.
Very true. Since spreadsheets can't predict the future, we have to look for behavioral clues from the company itself. And one of the most misunderstood clues is the dividend.
Oh, this is fascinating. Because conventional wisdom dictates that when a company increases its dividend payout, it's a sign of financial strength and confidence, right?
Usually, yes.
But a massive dividend can actually be a giant red flag, particularly for a growth-oriented company. If a cutting-edge technology firm suddenly starts paying out all its cash to shareholders, they are communicating something very subtle but profound.
What's that?
They're essentially admitting, hey, we have run out of innovative, high-return projects to invest this money into. Our high-growth days are over, so here is your cash back.
Exactly. It signals a transition from a dynamic growth engine to a stagnant cash cow. But a much stronger behavioral signal comes from tracking the insiders.
Oh, like what the promoters and top management are doing.
Yes. What are the founders, the board members, and the top executives doing with their own personal shares?
Right. Peter Lynch had a brilliant perspective on this in the source text. He pointed out that insiders might sell their stock for a dozen different mundane reasons. Maybe they are buying a new house, paying for a child's college tuition, or just diversifying their portfolio.
A sale doesn't necessarily mean the company is doomed.
Exactly. But if insiders are actively buying more stock with their own money, there is only one logical conclusion. They possess non-public knowledge that the company's future profits are going to be massive.
Because they have an asymmetrical information advantage. They see the daily sales data, they know what products are in the pipeline, and they know what contracts are about to close long before the quarterly report is published. If the people with the most intimate knowledge of the operational engine are betting their personal net worth on it, that is a signal no spreadsheet can replicate.
So to bring all of this together, becoming a true financial detective requires a total perspective shift. We started by gathering the essential documents, learning that a consolidated empire might look invincible while the standalone parent company is secretly starved for cash.
A vital first lesson.
Then we dissected the balance sheet, discovering that negative working capital isn't always a crisis. It can be a ruthless flex of supplier dominance. We navigated the P&L waterfall to isolate pure operational efficiency through EBITDA.
And then immediately check those paper profits against the harsh reality of the cash flow statement to avoid the accrual accounting trap.
Yes. We hunted for manufactured earnings in the notes to accounts and verified the truth through the auditor's unqualified blessing. Finally, we deployed DuPont analysis to separate genuine operational brilliance from dangerous debt-fueled leverage before looking to insider behavior to map out the future.
It is an incredibly robust toolkit for evaluating corporate reality. But as we wrap up this analysis, I think it is vital to acknowledge the ultimate limitation of everything we've discussed today.
Oh, what's that?
Well, we've spent this time learning to master the numbers on the page, the hard assets, the liabilities, the cash flows. But we operate in a modern, service-driven, technology-heavy economy. And in this economy, a company's most powerful assets often don't physically exist.
That's a profound point.
The brilliant minds of its human capital, the self-generated intellectual property that defines its competitive moat, the fierce, irrational brand loyalty of its customer base. None of these things legally qualify as assets on a balance sheet.
Which means the true intrinsic value of the most dominant companies in the world might be entirely invisible to the accountant's pen. As you analyze companies, ask yourself, how much of the company's true intrinsic value is entirely invisible?
It's definitely something to think about.
The financial statements tell a critical story, but they are only the foundation. It is up to you to figure out what invisible architecture is built on top of it. Take these tools, pull up an annual report, and see what hidden realities you can uncover. We'll catch you on the next deep dive.